In terms of whether the market got it right yesterday, in terms of buying treasuries, concluding effectively that the Fed has likely had its last rate hike as of July, and therefore it's now the countdown to when they might be able to ease.
I think they did. We've already not had a hike at the September and November meetings. December is not being priced anymore. I do think, the market can cautiously expect that the Fed will not hike again. I certainly think the Fed won't tell us. But I do think this move lower in rates tells you just how much breathing room the Fed actually does have in terms of not having to push rates sharply higher. You're seeing inflation slow down. The big question for us is going to be, is growth going to follow suit? And we think gradually it will. So we think that soft landing is not really going to play out as the market expects.
How is it going to be different than what the market expects? So you think that we're actually going to have a downturn in the economy eventually?
Correct. Right now, we're still calling for a second quarter recession next year. We do think things will slow down. We're seeing it very marginally at the moment. Certainly no signs of recession yet. But I think in the next 3 to 6 months, you are going to see retail sales slow down. You're going to see that consumer start to come off, and company profits are going to start to slip a little bit as well. And that will set up for a relatively modest downturn. We're not calling for anything akin to COVID or 2008, but more of kind of your run-of-the-mill recession that basically forces the Fed to come in and cut rates.
Got it. And Gina, in terms of how stocks took the news yesterday, now clearly we've been in about a 3-month downturn. We've come off the lows after that 10% correction, but the economically sensitive parts of this market, the riskier areas, have been hurt much more. They bounced more yesterday. What's your read on the action?
So I think that there are still some unpriced risks left in the market, but I think that all else being equal, inflation should continue to cool. And that is the assumption that everything else rests on. If inflation continues to cool, the Fed can continue to stay put, stand pat, and eventually that lack of inflation will be kind of a challenge for corporations. Remember that inflation is very good for corporations, and corporate earnings benefited greatly in terms of margin expansion during that inflationary bout. And that's going to start to go away. Margins are under pressure, and we're seeing that. So that should continue to go into the slowdown. And if you look at what has been blunting the effect, and the reason we haven't really gone into a recession is that a lot of consumption has blunted that effect. And that consumption used to be COVID stimulus, but it switched eventually to credit card debt. And that credit card debt is getting more and more expensive. So that at some point is unsustainable. So that says that the slowdown that a lot of economists have thrown in the towel on, that technical recession, is probably still in the cards.
No doubt about it. Credit card debt has gone up. Consumer balance sheets don't look as strong as they did. But is it not really just normalizing to where we would have expected it to be, absent some of the stimulus effects? It just seems as if we're not really at those extremes in terms of how stressed the consumer appears that we have typically been right before a recession, Gina.
Well, yes, except that if you compare credit card balances to previous credit card balances, you're forgetting the fact that those previous credit card balances were at rates like 10 and 12%, and now they're at rates like 20 and 23%. That is a very big difference in terms of the actual cost of carry, right? So that is taking a bigger bite out of consumption capability.
Gennadiy, in terms of the implications for the bond market, we've obviously been dealing with this situation where nobody was quite sure why long-term yields were going up when they were from the summer. There was obviously a component that the economy had been stronger. The Fed said we're going to keep rates higher for longer. And there was maybe a little bit of sticky inflation expectation, but also the big Treasury supply story. Where does that leave us right now in terms of your expectations for where yields can go?
I think it leaves us in a bit of a tug of war. And I think that's going to be the theme for the next 3 to 6 months. It's really this tug of war between, more supply, and I certainly think more supply is coming, and macro fundamentals. Supply really only matters when times are good, when stocks are going up, when investors really have a choice of what they can buy. Once the economy starts to turn, once you start to see the macro fundamentals really start to shift lower, then we get a sense that, supply doesn't matter quite as much. We are looking for more, safe haven assets. Inflation doesn't matter quite as much. So I do think you're going to start to get that adjustment probably sometime in the next 3 to 6 months. Right now, supply still matters. So I don't think this is going to be a linear move lower in rates. I do think this move is going to be quite choppy. And the market is going to react to data. It's going to react to auctions. It's going to react to just about everything. But, we're still long rates. We went long rates a couple of weeks ago. I think that trade's going to continue to work, but it's not going to go in a straight line.
And Gina, it sounds like, your preference would be to remain somewhat defensive and, not necessarily buy into this idea that we can have this relief rally turn into something bigger if the soft landing, is the expectation right now. How would you tactically look to position?
Well, one of the things that we know is that when the market is complacent, we think the market is complacent right now, you can do downside protection on your portfolio. And that, because one of the things we also know is that stocks and bonds have been very correlated. Diversification has not helped. We've seen stocks and bonds go down together, and now they're going up together. So one of the things we know is that you have to take a different tack to protecting your portfolio. We think some well-placed options trading is really where you need to be right now because a lot of the pricing reflects a lot of this complacency that we're describing.